Welcome to our comprehensive guide on how to analyze stocks. Whether you're a beginner or looking to refine your investment strategy, understanding the two main methods of stock analysis, fundamental and technical, is crucial. In this video, we'll break down both approaches, highlight their differences, and help you decide which method suits your investment goals. By the end, you'll have a clear understanding of how to evaluate stocks effectively and make more informed decisions in the market. Let's start by exploring what stock analysis really means and why it's an essential skill for every investor. Stock analysis is the process of evaluating a company's shares to determine their value and potential for growth. Investors use analysis to decide whether to buy, hold, or sell a stock. There are two primary methods: fundamental analysis, which looks at a company's financial health and performance, and technical analysis, which focuses on price movements and trading patterns. Both methods offer unique insights and can be used separately or together. Understanding the basics of each will empower you to navigate the stock market with greater confidence. Fundamental analysis involves examining a company's financial statements, management, industry position, and economic factors to assess its intrinsic value. Investors using this method believe that a stock's price will eventually reflect its true worth. Key metrics include earnings, revenue, profit margins, and debt levels. By understanding these factors, you can gauge whether a stock is undervalued or overvalued. This approach is often favored by long-term investors who focus on the company's overall health and future growth potential. In conducting fundamental analysis, investors pay close attention to several key metrics. Earnings per share (EPS) shows how much profit a company makes for each share. The price-to-earnings (PE) ratio compares a company's share price to its earnings, helping investors judge if a stock is over or undervalued. Other important figures include revenue growth, debt-to-equity ratio, and return on equity (ROE). These numbers provide a snapshot of a company's financial health and help investors make informed decisions. Beyond the numbers, fundamental analysis also considers qualitative factors. These include the quality of a company's management team, its competitive advantages, industry trends, and overall economic conditions. For example, a strong leadership team or a unique product can give a company an edge over competitors. Understanding these elements helps investors see the bigger picture and anticipate how a company might perform in the future, beyond what the financial statements reveal. Technical analysis takes a different approach by focusing on a stock's price movements and trading volume. Instead of looking at a company's financials, technical analysts study charts and patterns to predict future price trends. This method is popular among short-term traders who aim to capitalize on market fluctuations. By analyzing historical data, technical analysts try to identify signals that indicate when to buy or sell a stock. Technical analysts use a variety of indicators to interpret market trends. Some of the most common include moving averages, which smooth out price data to identify trends, and the Relative Strength Index (RSI), which measures the speed and change of price movements. Other popular tools are Bollinger Bands, MACD, and volume analysis. These indicators help traders spot potential entry and exit points, making technical analysis a valuable tool for active market participants. Chart patterns are visual representations of price movements that technical analysts use to forecast future trends. Patterns like head and shoulders, double tops and bottoms, and triangles can signal potential reversals or continuations in price. Recognizing these patterns requires practice, but they can provide valuable clues about market sentiment and possible price direction. By combining chart patterns with technical indicators, traders can develop more robust strategy. Technical analysis can be applied to various time frames from minutes to months. Day traders might focus on minute-by-minute charts, while swing traders look at daily or weekly trends. The chosen time frame depends on your trading style and goals. Shorter time frames can capture quick price movements, while longer ones help identify broader trends. Understanding how to select the right time frame is key to successful technical analysis. While both fundamental and technical analysis aim to guide investment decisions, their approaches are fundamentally different. Fundamental analysis looks at a company's value and long-term potential, while technical analysis focuses on price action and market psychology. Long-term investors often prefer fundamentals, while traders lean toward technicals. Understanding these differences can help you choose the method that aligns with your investment style. Fundamental analysis is best suited for investors who are interested in the long-term growth and stability of a company. If you plan to hold stocks for years and want to understand the underlying business, this method is ideal. It helps you identify companies with strong financials, competitive advantages, and growth potential. Fundamental analysis is especially useful during periods of market volatility, as it focuses on the company's true value rather than short-term price swings. Technical analysis is favored by traders who seek to profit from short-term price movements. If you enjoy active trading and want to capitalize on market trends, this approach is for you. Technical analysis helps you spot entry and exit points, manage risk, and react quickly to market changes. It's particularly useful in highly liquid markets where price patterns and volume provide actionable signal. Many successful investors and traders combine fundamental and technical analysis to make more informed decisions. For example, you might use fundamental analysis to select strong companies and technical analysis to time your trades. This hybrid approach allows you to benefit from both long-term value and short-term market trends. By integrating both methods, you can develop a more comprehensive investment strategy. While fundamental analysis provides deep insights into a company's value, it also has limitations. Market sentiment, unexpected events, or changes in the economy can impact stock prices regardless of strong fundamentals. Additionally, analyzing financial statements requires time and expertise. It's important to recognize these risks and use fundamental analysis as one part of your overall investment process. Technical analysis also comes with its own set of risks. Since it relies on historical price data, it may not always predict future movements accurately. Market anomalies, sudden news, or low trading volume can lead to false signals. Traders must remain disciplined and use risk management techniques to avoid significant losses. Remember, no method guarantees success in the market. Conduct fundamental analysis. Investors use a variety of tools and resources. Financial statements like balance sheets, income statements, and cash flow reports are essential. Online platforms provide access to company filings, analyst reports, and industry news. By leveraging these tools, you can gather the information needed to evaluate a company's true value and make informed investment choices. Technical analysts rely on charting software, trading platforms, and a range of indicators to study price movements. These tools allow you to visualize trends, set alerts, and backtest strategies. Many platforms offer customizable charts and real-time data, making it easier to spot patterns and react quickly to market changes. Choosing the right tools can enhance your technical analysis skills. Market sentiment refers to the overall attitude of investors toward a particular stock or the market as a whole. Both fundamental and technical analysts pay attention to sentiment, as it can drive price movements. News, economic reports, and investor behavior all influence sentiment. By staying aware of market mood, you can better anticipate trends and adjust your strategy accordingly. Major news events such as earnings reports, mergers, or economic announcements can significantly impact stock prices. Fundamental analysts assess how these events affect a company's value, while technical analysts watch for price reactions and new trends. Staying informed about current events is essential for both approaches, as it helps you respond quickly to market changes. Diversification is a key principle in investing, regardless of your analysis method. By spreading your investments across different sectors and asset classes, you reduce risk and increase the potential for stable returns. Both fundamental and technical analysts use diversification to protect their portfolios from unexpected market movements. Remember, no single stock should make or break your investment success. Every investor is unique, and the best analysis method depends on your goals, risk tolerance, and time horizon. Some prefer a hands-on approach with technical analysis, while others focus on long-term value through fundamentals. Experiment with both methods, track your results, and refine your strategy over time. The key is to stay disciplined and continue learning as you invest. Investors often make mistakes such as relying solely on one method, ignoring risk management, or letting emotions drive decisions. Avoid chasing hot stocks or making impulsive trades based on rumors. Instead, use a balanced approach, do your research, and stick to your plan. Learning from mistakes is part of the journey to becoming a successful investor. Stock market is constantly evolving, and staying informed is essential for success. Read books, follow market news, and participate in educational resources to expand your knowledge. Both fundamental and technical analysis require ongoing learning and adaptation. The more you know, the better equipped you'll be to make smart investment decisions. Let's look at a practical example of fundamental analysis. Imagine you're evaluating a technology company. You review its financial statements, noting strong revenue growth and healthy profit margins. The company has low debt and a history of innovation. After comparing its PE ratio to industry peers, you determine it's undervalued. This analysis gives you confidence to invest for the long term, expecting the market to recognize the company's value over time. Now let's consider a technical analysis scenario. You're watching a stock that has formed a bullish flag pattern on its chart. The price breaks above resistance with high volume, signaling a potential upward move. You use moving averages and RSI to confirm the trend, then enter a trade with a stop loss in place. By following your technical signals, you aim to capture a quick profit as the stock rises. Regularly reviewing your investment performance is crucial for growth. Analyze your past trades, identify what worked and what didn't, and adjust your strategy accordingly. Both fundamental and technical analysts benefit from keeping detailed records and learning from experience. This habit helps you refine your approach and improve your results over time. Emotions can heavily influence investment decisions, often leading to mistakes. Fear and greed may cause you to buy or sell at the wrong time. Both fundamental and technical analysis require discipline and objectivity. By sticking to your strategy and avoiding emotional reactions, you can make more rational choices and achieve better outcomes. If you're new to investing or unsure about your analysis, consider seeking advice from financial professionals. Advisors can help you understand complex concepts, develop a personalized strategy, and avoid common pitfalls. While it's important to do your own research, professional guidance can provide valuable support on your investment journey. To recap, fundamental analysis focuses on a company's value and long-term prospects, while technical analysis examines price trends and market behavior. Both methods have strengths and weaknesses, and many investors use a combination of the two. By understanding and applying these approaches, you can make more informed decisions and work toward your financial goals. Stock analysis is both an art and a science. Whether you prefer fundamental analysis, technical analysis, or a blend of both, the key is to stay informed, remain disciplined, and continuously improve your skills. The stock market offers many opportunities, and with the right approach, you can navigate it successfully. Thank you for joining us on this journey to better stock analysis. Wishing you success in your investing endeavors.